Why am I flipping and telling you I'm selling my SoFi stocks? The answer is not what you think. Felix here, and today we're diving into a strategy that could potentially multiply my returns on SoFi by 4x. Yes, you heard that right, 4x. So before you hit that panic button, let me assure you, this isn't about abandoning the SoFi ship. It's about setting sail for potentially greater treasures. We're going to explore why switching from owning SoFi shares to a specific strategy could be a game changer for any portfolio. So in this video, I'm going to recap why SoFi remains a stellar company, analyze this current stock situation, and then reveal the core concept behind this bold move. We'll compare the two strategies, weigh the risks and rewards, and by the end, you'll have a clear understanding of why this approach could be so powerful. And of course, a special thanks to my four-legged financial analyst, Winston, who's been working his tail off, sniffing out all the data. Speaking of powerful strategies, our trading portfolio is up 80% this year. Fancy learning how we do that? Well, come and join me next week. Completely free of charge. For about an hour and a half, I'll teach you our strategies, our automations, our systems, and how I trade only a couple of hours a week. Link is down below in the description. But let's take a quick trip down memory lane and remind ourselves why SoFi has been turning heads in the fintech world and is finally being rewarded. And of course, you could always go and check out many of my previous videos about SoFi if you want to learn more about this company. But first off, SoFi's financial performance has been nothing short of spectacular. We're talking about a 3-year revenue compound annual growth rate of 36%. In their most recent quarter, SoFi delivered a record revenue of nearly 600 million, 22% up year over year. But here is where it gets really exciting. SoFi isn't just a one-trick pony. They've successfully diversified beyond their original student lending business. Now, 45% of their revenue comes from non-lending sources. It's like they've gone from being a star quarterback to being the entire lineup. And let's not forget about SoFi's tech business. This could be the AWS of finance, as Anthony Noto keeps reminding us. Imagine powering the backend for many other fintech companies and also big banks. It's like being the electricity company in a world going digital. Everybody needs you. And let's not forget about user growth. SoFi isn't just adding more members, they're seeing an increase in the number of products used per member. It's like they're not just inviting more people to the party, they're getting everybody to stay for dinner too, and charging for it. And have you seen the deposit growth? Consumer deposits rose 2.2 billion quarter over quarter. That's not pocket change. But here is what really sets SoFi apart, the quality of their loan book. We're talking about personal loan borrowers with an average FICO score of 747 and an annual income of 168,000. Obviously far above average. So these aren't just prime borrowers, they're the cream of the crop of borrowers. And just when you think it couldn't get any better, SoFi announces they're entering the small business banking and financing market, which again has potentially huge potential. So with all these positives, why on earth would I even consider selling SoFi stock? Well, that's exactly what we're about to dive into. And trust me, the answer might just change the way you think about managing your money. Right, let's dive into the current state of affairs with SoFi stock, shall we? As I'm recording this, SoFi is trading at around $7.50 per share, but it'll work just as well if the share price goes up by the time you watch this, which hopefully it will. Now, imagine if SoFi stock price rallies to $20. It's not a completely outlandish scenario given the company's impressive growth and potential, falling interest rates, and many other things. So let's break down what that would mean for an investor holding SoFi shares. Say you've invested $200 in SoFi stock at the current price. That would net you 25 shares. Now, if the stock price increases to $20, let's calculate your potential gains. So we take $20, the new price, we deduct the price you paid for it of $7.50, the current price, so you're left with $12.50 profit per share. $12.50 times 25 shares that you own, you made $312.50. So your initial $200 investment would grow to $512.50. That's a rather tidy 156% return. Not too shabby at all. Now you might be thinking, Felix, that sounds brilliant. Why on earth would you consider selling? Well, here is where it gets a little bit more fascinating. What if I told you that there's a strategy that could potentially turn that 156% return into a 400 or even 500% return? And no, I haven't lost my marbles quite yet. This is where the power of options come into play. Before you run away and you say, I don't do options, it's complicated, it's crazily risky, hear me out on this one. It might just change your mind. For those unfamiliar, an options contract gives you the right, but not the obligation to buy or sell a stock at a specific price by a certain date. And we're going to focus here on call options, which give you the right to buy. So let's look at a specific example. As of now, you can buy a SoFi call option with a $10 strike price, expiring in June 2026, a long time away. And for the sake of calculation, let's say it's trading at a $2 price. You might be able to get a little bit less, but I want to keep the maths easy here. Each contract represents 100 shares. So at $2 per contract, the contract's actually worth $200. So with our $200 investment, we can now control 100 shares of SoFi instead of the 25 that we could buy outright. So that's the power of leverage and options trading. But it gets a bit more exciting than that. If SoFi's stock price rises to $20 during the next 2 years, I would pocket a profit of $900 to $1,000. That's a smashing 450 to 500% return. I'll put on the screen here for you a sort of metric which shows you the profit at every single price and with the dates across the top. So you can see what we're looking at here. I'm kind of looking at the middle ground here of this because I think that's the more realistic outcome. Now, before you start trading options, now, it's absolutely vital to thoroughly understand options before trading them. They are a little bit complex, and you need to understand your risk tolerance and your investment goals and everything else. But to recap, with our $200 investment, you buy the stock, you have a potential 156% return if the stock hits $20. If you buy this call option, you have a potential 450% or more return for the same amount of money. The difference is staggering. But remember, with great potential must come greater risk. So you might be wondering, Felix, is this the right move for me? Well, let's pit these two strategies against each other in a proper financial boxing match. In the blue corner, we have the traditional stock ownership approach. In the red corner, we have our plucky challenger, this long-term option strategy. So round one, potential returns. As we've calculated earlier, if SoFi stock price rises from $7.50 to $20, our $200 investment would grow to $512, a respectable 156% return. However, our option strategy could potentially turn that same $200 into $1,000, a whopping 450% plus return. So options take this round by a landslide. Round number two is risk. Here's where it gets a little dicey. With stocks, the worst case scenario is SoFi's share price dropping to zero, resulting in a complete loss of your $200 investment. Realistically, even if the stock price halves, you'd still have $100 worth of stock. With options, however, if SoFi's stock price doesn't reach $10 by June 2026, your options could expire worthless, resulting in a loss of your $200 investment. Now, you can sell the contract earlier. Say if it's down $100, you get out. So there is a risk management we can use here. But short of the stock going out of business, the options trade has a little bit more risk. So stocks do win this round on the risk front. What about flexibility? Let's make that round number three. With stocks, you have the flexibility to hold indefinitely. You can wait out market downturns and sell whenever you choose. Options, on the other hand, have an expiration date. I'm picking one here that's really far out, almost 2 years. But you are working against the clock on this kind of trade. Having said that, we have 2 years here, and even if the stock only moved to $11, we'd still make a modest gain. But I would argue the stocks take this round simply because you could wait out a 2-year lull in the market. I can't with my option. Round number four, capital efficiency. Here is where options really shine. With $200, you can control 100 shares via options compared to owning only 25% shares outright. And this leverage allows you to potentially profit from a larger position size with less capital. So you could also therefore say, well, say you wanted to put more than $200 into SoFi, you could actually put in less capital, so therefore have less risk and still control the same amount of shares. So I would argue that options win this round handily. The final round is the suitability for different investors. This round really depends on your individual circumstances. If you are a long-term investor with a lower risk tolerance, stocks might be more suitable. I also have a significant long-term investment portfolio and I buy and hold great companies. Why? Because you can weather short-term volatility and potentially benefit from long-term growth. But if you want to be a bit more of an experienced investor with a slightly higher risk tolerance and a shorter time horizon, options could potentially offer much higher returns. So this round is kind of a draw. It really depends on your personal situation. So there you have it. Both strategies have their merits and drawbacks. The stock approach offers lower risk, maybe more flexibility, although really the only real advantage is that you can hold for longer. While the option strategy provides potentially higher returns and you can put less capital into the investment. And if you're still wondering why on earth am I suggesting selling SoFi shares when I'm downright bullish on the company, think of it this way. If you're utterly convinced a particular racehorse will win, would you bet on it to show or would you bet on it to win? That's essentially what we're doing here with our option strategy. By choosing the options approach, we're not just betting on SoFi to perform well, we're betting on it to perform exceptionally well. So it's a little bit more of a bold move driven by my strong conviction on SoFi's potential. However, let's not get carried away. The strategy, like any high reward approach, comes with its fair share of risk. First and foremost, there's the risk of total loss. So if our stock price doesn't reach our strike price by the expiration date, yes, we could exit the trade early and walk away with a partial loss. If we just sit on it for literally 2 years, which I wouldn't, then we'd lose all of our money, much like you would with stocks if the company completely went out of business. So from my perspective, this approximately 2-year time frame for the trade aligns perfectly with SoFi's growth trajectory. We're giving the company time to execute its strategies, expand its user base, and potentially realize the AWS of finance ambitions. Moreover, the approach allows us to control a larger position with less capital. We're essentially leveraging our conviction, which could lead to significantly higher returns if we're right. So remember, if SoFi stock price reaches $20, our potential returns could be 400% or more compared to 156% with direct stock ownership. Now, as always, any strategy that offers higher returns, so any strategy at all, it's crucial to only ever allocate a portion of your portfolio that you can afford to lose. Diversification remains key. Even if you're feeling bullish, you got to do your own research. Consider this option as the spice in your investment curry. It adds flavor and excitement, but you wouldn't want your entire meal to consist just of spice. So in conclusion, this strategy is not about lacking faith in SoFi. It's quite the contrary. It's about having so much confidence that I'm willing to take a calculated risk for potentially higher reward. Remember, in investing, there are no guarantees. With careful analysis, the right conviction based on data, sometimes a bit of luck, we might find ourselves in the winner's circle. So don't forget about the risk. If you don't know what the heck you're doing here, if you don't know what options are, don't do it. You can get yourself a simulated trading account and you can play it out. That way you won't lose any money, and that's probably the smartest thing to do right here. So don't just do something because I am. But it's these kind of strategies that have allowed our teaching portfolio to be up over 80% already this year, which is a $24,000 gain on a $30,000 portfolio. And if you want to learn more about how we do that, come and join me next week. We're running a completely free live trading challenge or live trading training for beginners. I'll teach you our strategies, how we find the trades, how we set them up, how we automate them, and everything else so we can trade in just a couple of hours a week and still enjoy our life or go to work or whatever it is that you choose to do with your time. So find the link in the description. It's the link at the top. Click on it, register, and I look forward to seeing you next week. What if I told you that a single golden retriever outperformed 98% of professional fund managers last year? Well, my furry friend Winston didn't actually pick the stocks, but the 9 companies we're about to discuss have shown such remarkable performance, even a dog could have spotted their potential. Welcome back.